Okay. All right, well, last week I went through, and actually the first week was, of course, why the theory of individual demand you get from neoclassical theory is crazy. It simply can't work for computational reasons alone. And even if you pretend it's okay, then what you get out of that is a demand curve that can have any shape at all anyway. It doesn't actually justify standard supply and demand analysis. And last week, on top of that, even if you could get away with a downward sloping market demand curve, the theory of supply is irrational because what they call a profit maximising formula is provably false. It doesn't maximise profits, and profit maximising firms don't set price equal to marginal cost. So that's pretty much a mess. And once you've got that, of course, because you can only derive a market supply curve if the point of supply at every price level is the marginal cost curve, then once you don't have perfect competition, so-called, you can't get a supply curve anyway, which is independent of the demand curve. And you can easily derive, as I showed last week, a downward sloping supply curve, which is not what the theory wants. So that's a mess at the level of both micro and macro. And it's also a mess at the level of finance, because again, what is defined as rational behaviour in finance is provably irrational. So I'm going to go through a few examples now. I want you to grab a piece of paper, or you wrote in your notepads there, and say what you do if you're presented with the following choices. Now, I want you to actually imagine this is serious. It's actually going to, if it's a case of, I'm going to give you $1,000, if you chose option A, you would walk out of this theatre with $1,000, okay? It's not something which you treat facetiously. So the first choice is, guaranteed you get $1,000. Or you have a gamble where you've got a 90% chance of getting $2,000 and a 10% chance of losing $1,000. Okay? So the two choices, either $1,000 for sure, or 90% chance you'll get $2,000, but a 10% chance you'll lose $1,000. So work out which of those you'd actually prefer. Write it down. You got an answer, all of you? Okay, right, next one. Nothing for sure, so nothing happens. Either you don't no chance for the amount of money in your wallet, or a gamble. We've got a 50% chance of getting 150 and a 50% chance of losing 100. So either do nothing or take open a gamble where you might make 150 on the toss of a coin, but you could also lose $100 if the coin comes up tails rather than heads. So decide which one of those you prefer. Do nothing or take the gamble. You all done that? Okay. Another one. For certain, they're getting worse each time, as you can see. For certain, I take $100 out of your wallet. So if you do nothing, choose A, I take $100 out of your wallet. Or you take a gamble where you have, a coin toss. You might make $50 if it comes up heads, but you'll lose $200 if it comes up tails. Okay. So, which of those would you choose? Okay, let's go through what you've got. This is the results from the day class at Campbelltown. Who chose A for the first one? It's too many to try counting, but I'll say that's about half the class. Who chose B? Slightly more than half, okay, much the same as Campbelltown. For the second one, who chose A? Smaller number. Who chose B? More, larger majority, okay. And third, who chose A? And who chose B? Okay. You've just proven you've done courses in finance, because when that's done with normal people, and by implication you guys aren't normal, that's not what people choose at all. What most people choose is A in the first two cases and B in the third. I think the reason why you choose majority most of the time you choose B is you've sat through exams where you get told here are two choices, what should you do? And if you don't answer the option that turns up being B, economically you fail the multiple choice. Because you've been trained to believe that what you should do is maximise expected value. So whether you did it actually logically or not, most of you have actually given the same answer you'd given a multiple choice question in another course in finance. But in fact, humans, people who haven't done a course in finance, actually choose A for the first two and B for the second. Now again, we've got this old dilemma, just like we did with looking at the behaviour of simple students. Does that mean most people are irrational, except people who've done economics courses in finance? Well, according to a neoclassical theory in finance, yes, that would be the case, because what a rational person does is maximise expected return, and that's simply multiply the probability by the return, add them up and see what you get, and you take the best situation. And each of those three problems I gave you, B has a higher expected value than A. So you look at the first one for A, it's $1,000 for sure, worth $1,000. B, on the other hand, is a 90% chance of 2,000, that's worth 1,800, minus a 10% chance of losing 1,000, so that's a total of 1,700. Similar calculations for A and B in the other two examples. So in each case, economic theory says the rational thing is to choose B over A, and being people who've studied this stuff, that's what you all chose. But a large number, remember, a large number of you also chose A. Okay? In fact, a larger number that would have chosen that option doing a finance course, because most of you actually passed that question in finance exams. So why do you reckon most people don't? Why do people not do what economic theory says they should do? Yeah. Which is the sort of risk aversion. Okay, they're averse to the risk, so they keep the safe option. Okay, because in each case, what I gave you there was no gamble involved in A. You knew it was going to happen, so that's risk aversion. Any other possible? Yeah.
Survival is more important than expected return than traditional theories.
Pardon, my hearing is bad. Sorry.
Survival, wealth preservation is more important than wealth maximisation than traditional theory acknowledges.
Yeah, that's loss aversion. You're averse to the possibility of a loss. So even though you've got a higher expected value, you might get the negative outcome. So to avoid that outcome, you choose A. Okay, that's another explanation that you'll find in the behavioural finance lecture. Yeah.
People have problems calculating.
People have problems calculating. I'm not going to argue with that. That actually happens later on with some of the, as I did with the later class, people actually made mistakes in their calculation. Yeah.
Possibly other considerations that have to do with the return.
Other considerations not to do with return, like what?
One time where you were at may not be interested, where you've got a high level of wealth, you don't really care whether it's 1,000 or 1,700, make a big difference.
Your personal situation intrudes in some way, and that might also be down to religious belief. You might be against gambling, okay? Because this is all about gambling, in effect, when you look at it. Okay, so there's the reasonable straw polls. I'll jump past writing them down. Now I'm going to repeat the same experiment now with one difference, and that is, whichever of the options you choose, it'd be repeated 100 times. So if you chose A now, we'd go through that gamble 100 times, and you'd walk out with $100,000 guaranteed. Okay, so now I want you to do the same thing again. So again, I have 100 repeats of this choice. Either you choose A, so 100 times I give you $1,000, or you choose B, where you have a gamble that each time you've got a 9 in 10 chance of getting 2,000, but a 1 in 10 chance of getting minus 1,000. It's going to repeat 100 times. So work out which one you prefer now. All worked it out? Okay. Even those who were slow in calculations? Okay. Now, again, 100 repeats. Have either nothing at all, or a toss of a coin where you get either 150 if it's heads, or minus 100 if it's tails. Work out which one you prefer there. Done that? Okay, third one. Either minus 100 bucks for sure, or again a coin toss where you either make 50 if it's heads or you lose 200 if it's tails. Whichever one you choose, it happens 100 times. You choose A, you walk out here $10,000 poorer. Okay. B, work it out. Okay, so let's go through that one now. So, who chose A in the first case? If you chose A, who chose B? Much larger number. In 2, who chose A? Okay, who chose B? Almost the whole class. And about C, who chose A? Quite a few. Who chose B? Again, the majority. Okay, you've now flipped over and you've now done what neoclassical theory says is rational. Okay? But the reason you have, almost all of you, is because something about doing it more than once. And this comes down to what in statistics is called subjective versus objective probability. Because when I say there's a single gamble, like for example B in the first case, where you either get $2,000 or minus 1,000, what do you actually get if you play it once? Do you get 1,700? You don't, do you? That's the expected value, but you get either 2,000 or either 1,000 or either get $2,000 or minus 1,000. You don't get 1,700. So in a one-off gamble like that one, those are the outcomes. So that's what you're told of the odds. Now subjectively, you would think, oh, I'm pretty good chances of getting 2,000 in the second. But if you play it, you either get 2,000 or minus 1,000. You do not get 1,700. So the actual outcome of A is the expected return, but the actual outcome of B is either 2,000 up or 1,000 down. It's not 1,700. So you don't get your expected return. But on the other hand, if you play it repeatedly, like 100 times there, you get your expected return, or pretty close to it. You could actually do a statistical test and say, what are the probabilities of getting 90 throws of getting 2,000 and 10 of getting minus 1,000? That's the most likely outcome. But you might be really unlucky and get only 80 of the 2,000 outcome and 20 of the minus 1,000. That's still positive and that's still bigger than the A. And you could work out the odds of getting all that. So you could apply serious statistics to work out what the likelihood was and make the obvious choice that even though you're going to lose between 10 and 20% of the times, it's highly unlikely you'll lose 50 or 60% of the time you'll come out ahead compared to the certainty of getting 1,000 in the first case. So the difference is that a one-off gamble is fundamentally uncertain. Even though you're told that it's a 9 in 10 chance, that gives you zero information about what the actual outcome is going to be. If it gave you any more information than that, it wouldn't be gambling. So that's your problem. Probability only applies as an accurate guide to what you're going to get if you do it repeatedly. Doing it once, probability can't tell you which one you're going to get. So your subjective odds might be 90%, but objectively you can't say what's going to happen. So your outcome of a single throw isn't probable, even though you're using stats for it. It's uncertain. And that is the problem, the key problem in conventional finance theory. Well, there's lots of key problems in conventional finance theory. That's certainly one of the most important. But I'll just go through how we got to the situation that people actually use this idea to tell you what's rational in finance. And as seems to be the case in economics all the time, really annoys me, it comes from a flawed reading of a good reference. Often it's also a flawed reading of a bad reference. This particular time around, John von Neumann and Oscar Morgenstern came up with an interesting idea about how we might actually improve economic theory given a few problems that they were willing to admit. And they developed the expected return, expected utility approach in a book published in 1944 called The Theory of Gains and Economic Behaviour. And their objective in that was to make things like utility in economics, which are unmeasurable, make them measurable. Now, this is something most people who work in economics don't know. What then happened was those concepts were borrowed by the people who developed CAP-M, amongst many other things they also borrowed. They stole the heat equation from physics and so on. Now, von Neumann and Morgenstern were aware of this distinction between objective and subjective probability. And they actually did, in writing the introduction to that book, was say, we insist, and that's literally the word they used, on using objective probability. And the argument was that probability, you can see it as subjective, so that's the way that you're told to, you actually are using it when you do that one-off choice and work out a so-called expected return. But he said, we propose to use this in constructing a numerical estimate of utility. And he said, therefore, subjective probability doesn't suit our purposes, so, and look at this, the simplest procedure, therefore, is to insist. Can't put it much more strongly than that. I've put the bold in there, but they literally said the word insist. Upon the alternative, perfectly well-founded interpretation as frequency in long runs. So that's how they said they should have been used. Now that was ignored, and much else, by the people who developed what they call modern finance theory. So as usual, economics took itself up the garden path, or maybe down the garden path through the looking hole following Alice. Now von Neumann and Morgenstern, particularly von Neumann, who is one of the world's greatest intellects of all time, and a leading physicist involved in nuclear physics and the development of computing and so on, he was critical of economic theory, and in particular, he thought indifference curves were a joke. He wanted to get rid of them. And he gave lots of arguments in this opening chapter of the book about why you shouldn't use them in economics. And he said, for a start, they presume either too much or too little. He said, and look at this, he's actually aware of the issue I raised in the first lecture, that an individual can't work out whether they prefer shopping trolley A to shopping trolley B when there's lots of shopping trolleys. And there's lots of shopping trolleys as soon as you include more than a handful of commodities. So he said, if an individual can't compare the utility they get from two different bundles, then indifference curves don't exist. So he's aware of what I took you through in the first lecture. But he said, if on the other hand you can do the comparison, he said, then we can actually work out a numerical value for utility, which means indifference curves are useless. So his intention was to get rid of indifference curves, which had only been brought in by Samuelson a few years ahead of this book. Now what he argued was the whole idea of not having the ordinal ranking, as you're told. You can order preferences, you can't rank them cardinally by saying one is X% better than another. He said that's a sign of immaturity. He said there's plenty of examples in physics where there were concepts which were pre-numerical, for example, temperature, and as theory developed, you get measurement coming out of the theory. So rather than saying something is hot and something else is cold, or hotter and colder, you can say this is 27 degrees Celsius and this is 4 degrees Celsius. And that measurement came out of improving theory. So he said you start from ordinal, and as you get more mature, you get a cardinal ranking. And the arguments that economists this couldn't be done was nonsense, he said, and he showed how to do it. And the basic idea was use gambles, but repeated gambles, not ones where it's only one-off, where the individual situation you're in, can be bad. As Usman said, let's say like you might be starving, so you desperately need an extra banana, okay, and you won't even consider the gamble of 2 bananas because you have to have one to avoid starvation. If this is about bananas for the rest of your life, then that issue doesn't come into it. So he said, but if he was aware to begin with that this numerical thing itself might not work, and here's the statement, again emphasising this one may doubt whether a person can always decide which of 2 alternatives he prefers. Now, he didn't actually work that through. I wish he had, because he certainly had the mathematics to work out the curse of dimensionality, and he realised pretty rapidly the whole idea of being able to work out anything about individual utility was pretty much a waste of time. But he said, even if we take that doubt into account, what he did do is say, well, if you do doubt that, whatever the doubts are, it applies to both the non-numerical indifference curves and the numerical alternative he was trying to bring in. And what he said was, you can actually, if you can actually make the comparisons, so we're now ignoring the problems I covered in the first lecture that you can't, saying if you can make them, then it's possible to work out a numerical value for utility. And what he got was a set of axioms, which I'm now comparing to Samuelson's axioms. So Samuelson had completeness, saying you can rank in an ordinal way, A better than B, B better than A, or indifference. What he said is, well, as well as doing that, you can make a numerical conversion using this function b, so you get a value, a numerical value, or you can say that b, if you prefer A to B, then the v of A is greater than v of B. Transitivity applies, but which is the same as Samuelson, but rather than saying that there's A is just preferred to B and you can't say by how much, now you can say, and you can also say that you can give some probability of getting, if A is preferred to B, then there's some probability of getting A versus nothing at all, which makes the chance of getting A on a repeated gamble equivalent to the value of getting B. And then non-satiation and convexity aren't necessary. They could happen, but it doesn't really matter. The basic idea is assign some arbitrary value, a bit like the way that we originally developed temperature scales by saying the freezing point of salt water was 0. And then the freezing, I don't know why 32 was chosen for the freezing point of fresh water, but that's what gave us the Fahrenheit scale. At 212 degrees was the boiling point, I think, of fresh water. I don't know if that applies to salt water. Well, he said, obviously, if you have 0 bananas, the 0 of a commodity, let's give that a value of 0. You hear I'm saying 1 banana is worth 1 util. Now, you can generalise this to more than one commodity. I'm just sticking with 1 here because it works with 1. So I just like using that freezing scale idea. Then you offer the consumer a repeated gamble of either getting 1 banana for certain or alpha percent odds of 2 bananas versus 1 minus alpha of none. Now bear in mind, if you lose it once, you do the gamble again, the next time you'll get 2 bananas rather than 0. Okay, if the odds turn your way. So it's not a case of a one-off choice, it's something which should be repeated indefinitely. What he said was, if given that choice, repeated choice, then the consumer chooses the gamble when alpha equals 0.7, you can therefore say that the utility of 1 banana is 0.7 times the utility of 2 bananas. And using that, you can now use a calculation. Now here I'm using 60% here in this example, just to get a better curve. But say there's a 60% chance of 2 versus a 40% chance of none, and at that point, you decide you'll take the gamble. This 1 banana therefore gives you 60% of the utility of 2 bananas. And therefore, now working numerically, 1 util is 0.6 times the utility of two bananas. So the utility of 2 bananas is 1.67. You just divide the utility of 1 by the point at which you're willing to take the gamble on. So you get a 1.67 level, and therefore you can say the marginal utility of the second banana is 0.67. So you've now got a numerical way of talking about both utility and comparisons of utility. You keep on going, you take a choice between 2 for certain versus a gamble of 0 and 3, 3 for certain, etc., etc. And what you can finally do is develop a table like this. And those are the various gambles you're taking. So what I've gone is there's the 1.67 level, that becomes the utility of 2 bananas. And then you say, what are the odds of getting 3? Would you take the gamble there? Well, then you say, if you take 3 when the odds are 78%, then I can say the utility of 3 bananas is 2.141. That gets fed into the next level, and on you go. And ultimately, you get a curve like this, where you can say, there's your total utility in numerical sense from consuming bananas, and there's your marginal utility. So it's turning a non-measurable concept into a measurable one. So it was meant to be a replacement for ordinary utility and indifference curves. But that ain't what happened. Instead, they completely ignored the numerical case, and you'll still be taught in first-year classes and all. I'm sure the honours classes teach the same thing, that you can't give a numerical value to utility. Well, to paraphrase Obama, yes, you can. Okay, not necessarily useful, but you can do it. But they ignored that, and they combined the idea of expected return, expected utility, and so on, with existing economic theory, which included indifference curves, to give us what they called modern finance back in the 50s and 60s. And that was seeing investors maximising a non-numerical utility given a budget constraint. So it's a transference of simple micro across to the area of finance, using both, a bastardised version of von Neumann and confusing risk with uncertainty. Now there's lots of asset components to it. The one I'm going to focus on is the very first, which is Sharpe's capital asset pricing model. And they called it modern because it was modern compared to what was written in 1950. And it appeared initially, one reason it succeeded, it appeared to explain what the old finance theory couldn't do. It doesn't look so crash hot about half a century later, of course. Though I believe that's still not, people are still teaching this stuff in finance courses. So, okay, let's go back to Sharpe's CAP-M model. And he said the objective he had in writing the paper was to predict the behaviour of capital markets. And what he took was, he took theories of investment under certainty and extended it to conditions of risk. Now, risk ain't uncertainty. We'll go through that in more detail later. But the basic idea was that you have the investor maximising utility subject to constraints where that utility was a positive function of the expected return and a negative function of the standard deviation or variance associated with each particular asset they were looking at. Okay? And the constraints, so that's your indifference curves. Your budget line is the actual availability of investments that have those characteristics of both expected return and a standard deviation or a volatility of that return as perceived by the individual investor. That's a hint, of course, that he has a bit of problem getting to the collective of the market. So the expectations of the volatility of return, the return itself, and the correlation it has with other assets. So it might be, for each particular stock, you'd have something like this. You might expect IBM to give a 6% return per annum, have a standard deviation of 3%, and have a minus 0.67 correlation with CSR. And out of that, he derived this beginning diagram. Have you seen this diagram before? Most of you haven't. Okay, this is out of the original paper. And there's the idea of increasing utility. So as your expected return rises, you have rising utility, and as the standard deviation, which is here, falls, you also have expected utility, rising utility. So the curves rank that way. And the investment opportunity is this big cloud here. Now that might be where IBM is, that might be where CSR is. The only ones you should actually consider are the ones on the rim here, along that curve he called the investment opportunity curve, because if you choose Z, for example, then B, C and D are all better in various ways. And that's the optimal combination for that particular investor. Given those preferences, the only investment they should consider going into is investment F, whatever that might be. Now, there's a couple of clever bits to the paper, and this is one of the clever bits. He proves that things like F must involve a portfolio. It can't be a single share. And the argument he gives is if you have a single investment like A, it's going to give you the expected return of A and its standard deviation. B would do the same, but if you have a combination of the two, say alpha percent of your investments in A and 1 minus alphas in B, then your expected return is going to be that linear sum again, but your standard deviation is going to be a real mess. It's going to have terms for the variance due to A, the variance due to B, and the correlation of the two assets. And what he then shows is if that correlation is perfect, then the risk lies on a straight line just as the return does. So if that's the overall expression for the standard deviation of the portfolio, and that's 1, then that whole thing factors. Pardon me. It's the square root of that expression squared, which means it's simply that expression. And that's exactly the same sort of straight line relationship as for expected value. So what you get out of that is that C is going to lie on a straight line between A and B. But if on the other hand C is, for example, 0, so there's no correlation between the two assets, then it's going to be a curved path, because that expression, if that's 0, that whole expression is therefore 0. So therefore this bit is what you're left with, and that's provably less than that whole thing. Okay? So in that case you get lower risk for diversifying your portfolio, and that's really about the only interesting thing you'd find in modern finance. So therefore any point that's below that straight line relationship has to be a portfolio. That therefore means that anything that's actually on the curve, on the edge of that investment curve, is going to be a portfolio rather than a single share. Now so far I've explained a single person and where they invest in the absence of the capacity to borrow money. But now he assumes that if the investor can borrow any amount they like, and they can either borrow money or they can lend money at that rate, an asset which returns the pure return of ERP and has absolutely no standard deviation. And you can borrow as much as you like. What that means is you can actually have a portfolio that's not just that one little spot, but anywhere along this line you want to go to, given your willingness to borrow money. And the question only now is, what's the slope of that line? Well, what he shows is, of course, that if you want to combine that riskless asset with a risky one, again, there's only going to be one point that makes any sense, because if you make the slope of your line this dotted line, You're choosing investment here, but you can get a better return from that one, and the best return of the lot you can get is by that portfolio. So the only thing you should do is decide whereabouts on this line you're going to place yourself. That's the only choice you face. That's good. That's the theta happens to be the only asset that, given your expectations about the future, is worth you investing in by either borrowing money and levering a position out here somewhere, or buying exactly that asset, or maybe lending money out and having some combination of the two so you get a lower return but a lower level of risk. So, that's the theory of a single investor. Big question. How did he go to a market? Well, if you think about it realistically, if you can even imagine there's such a thing as a riskless rate, surely it's going to differ for different investors, because I don't have the leverage that Jamie Packer has when it comes to bargaining over rates. And of course expectations are going to differ too. I won't have the same expectations as you about BHP and CSR, otherwise nobody would ever sell any shares. There wouldn't be any trading on the stock market. So if you had Fred Nurk and Jane Nguyen and Bill Gates, they'd all have different Ps, they'd all have different expectations. And they might be putting their ideas about where those shares would be are totally shuffled around. So how do you go from the theory of an individual investor to the theory of the market? Well, after the last couple of lectures, you should guess how a neoclassical economist does this. He assumes we're all the same, except for the fact we differ in our risk preferences. And this is how he states it. In order to derive, now there's the conditions for equilibrium. Whenever you need conditions for equilibrium, and that's the major thing that drives your theory, I think you're in trouble. Okay, here we go. We evoke two assumptions. First, we assume a common pure rate of interest. All investors able to borrow or lend on equal terms. So if you wanted to borrow $1 billion tomorrow to go and buy a small company like BHP, go ahead. Bank will lend it to you. If you wanted to lend $10 billion to some Arab principate building the world's biggest tower, you could do it. You too could be a major financial corporation. Then you also assume homogeneity of investor expectations. What does that mean? Well, you assume everybody agrees on the prospects for all shares. Everything about them is identical. Well, whoopee-doo, he admits that's rather weird. Needless to say, these are highly restrictive and undoubtedly unrealistic assumptions. So how does he continue going on with nonsense like that? Well, he says, and this is a perverted version of Milton Friedman, the proper test of a theory is not the realism of its assumptions, but I love this, the acceptability of its implications, whatever that means. And what he says is, well, these assumptions imply the equilibrium outcome we've always believed in finance, and since we haven't got any other theory, we shouldn't throw this one out. On that basis, he got a Nobel Prize. I reckon he should have been interred, but anyway. So he's appending it by this appeal to instrumentalism from Friedman. Now that's a bad version of Friedman's own methodology. Itself it certainly wasn't crash hot. And I've got a link to my lecture on that topic there. But to me, it's yet another case of proof by contradiction being mistakenly believed by neoclassical economists as the basis of deriving a theory. Because if you have to assume that all investors are identical to get the capital asset market line, then there can't be a capital asset market line. Simple as that. Now, it could have been what I'm calling here a heuristic step. So you could start with that assumption and then generalise it and see what you got out of it. And I talk about that again in History of Economic Thought. But instead, that's as far as he went. So it's based on these quite absurd counterfactual assumptions. Now, I'm okay about simplifying assumptions. Things that say you don't need to worry about the colour of the grass on the side of the road when you draw a map for the road system. But I'm not happy about counterfactuals, which, for example, assume you can get to the moon by jumping because you assume there's no gravity. I mean, that's nonsense, but that's the case of it. So what he's saying is everybody agrees about stocks, and everybody's got a limitless capacity to borrow at the same rate. And he doesn't mention this in the paper, though it's mentioned in later when it's dissected by once believers of the theory to show that it simply can't work. He also assumes your expectations are right. So he's assuming everybody who trades in the stock market is one of two people, either Nostradamus or God. Now, the consequence of all that, though, once you assume everybody's Nostradamus or God, and therefore all the other stuff follows, then The spectrum of available investments is the same. P is the same. I'm sure God can borrow at limitless amounts of money at a riskless rate. So the P theta Z line is the same for all investors. The only way you differ is your preferences for risk. And therefore you distribute along that line depending on whether you're a thrill seeker or you're highly conservative. So down here we've got somebody who's highly risk averse, choosing A, which means they've got a portfolio that's a mixture of investment in the bond and some shares. There's a thrill seeker who levers up their position, higher return with higher volatility, and there's somebody who's risk neutral that just puts all their money into the stock market. Now, that's, off with the fairish stuff, as is typical for neoclassical theory. The next part comes slightly clever, and that's to say, well, if everybody's buying theta, then the price of theta is going to rise. Okay? And therefore, the price of assets that aren't in theta will fall, and those changes in prices will shift the expected return. So the return on theta will fall, the return on other ones will rise, and what you do is you flatten that cloud. So the cloud now becomes, rather than just a single point of tangency, there's lots of points of tangency, and therefore there's lots of efficient portfolios. Okay, it isn't just the one. Now, of course, the theory, when you try to test this mad theory, people just use the S&P 500 or the Russell 3000 or the Russell 5000 to get as broad a representation of the market as possible. But according to Sharpe, there should be lots and lots of efficient portfolios. Now, this is the next clever bit. I'll go through this moderately rapidly because to me it's not important. But this is what you spend most of your time in finance courses going through. Individual assets will lie above the capital asset market line because there's no diversification. So you can't relate easily the return on an asset and its standard deviation. But you can relate the return on that asset to systematic risk, which is the correlation of an individual share with the stock market. And the way he does it is to say that an individual investment, like for example buying IBM, can be part of an efficient portfolio that includes the IBM, CSR and a couple of others. So what you can do is just an additional alpha amount in I, and therefore 1 minus alpha less in G. And if alpha happens to equal 1, then all you're doing is buying IBM shares. If alpha is equal to 0, you're still buying some IBM shares because you're investing in the portfolio that includes IBM. So alpha has to be negative to mean there's no investment in IBM whatsoever. The only efficient one is alpha equal to 0. Now that's what he shows there. And there's the single investment. So he's trying to work out how do you put a value on the single investment. Well, the way you go about that is you use the tangency to the capital market line of the curve, that IGG curve, and you can then derive this relationship, which is the classic beta. So he's saying expected return of an asset is the riskless rate of return plus this term multiplying the gap between the return of an efficient portfolio and the market return, and this thing here is beta. Okay, that's the volatility or the standard deviation of I divided by the standard deviation of the efficient portfolio multiplied by the correlation of I with G, and that's how beta is calculated. Okay? So all that stuff. Have you seen beta expressed that way before? If you do honours, you might get it in the honours course, but that's what's actually going on. So then what you get is the remaining risk you have is just the volatility due to a particular asset. The slope shows you the return in general by being more highly correlated with the trade cycle. And then you get the basic argument that the more volatility you get, you're willing to accept the higher return you get. So you can't get away from systematic risk. There's risk inherent even in the efficient portfolio. But the more you take on, the higher volatility you take, the higher return you're also going to get. So that's the basic argument. There's a trade-off between risk and return. Similar for Modigliani and Miller, they make the argument that debt doesn't matter. Really useful argument to make now. And the combination is the whole efficient markets hypothesis that says don't try to pick the market, just work out what a person's risk profile is, get them a diversified portfolio that fits that, and that'll be all okay. And all they're going to worry about is expected return, risk and correlation, etc., etc. And that's really what dominates the conventional courses in finance that you do. Now, all that stuff works so long as there's a common pure rate of interest that everybody can borrow at the same rate, and you all have the same accurate expectations about the future. Now, even though the textbook teach this stuff without going into this detail, the person, often you'll find the people who develop this stuff, maybe they wake up one morning with a dose of reality. They got hit over the head by a falling beam or something, or God knows what, and they admit to qualms with their theory. So here's Sharp doing that and saying people often passionately hold to beliefs that are far from universal. So he's admitting this homogeneity of investor expectations is nonsense. If the seller of a share in IBM may be convinced that its current price is a lot higher than it should be. Of course, the buyer is going to be convinced that it's lower than it should be. So otherwise there wouldn't be trading. Fundamentally, the capital asset pricing model is a theory about why there should be no trading on the stock market. But he said if you actually try to bring this in, what happens to the theory? Well, rather than seeing it might be a leg on the way to a more complicated and realistic theory, he says if we try to bring it in, the consequences are disastrous. And what are the disasters? Well, the capital market line disappears. There's no single optimal combination. The security market line also disappears. Punchline, the theory is a shambles. Now, I wish that realism turned up in your textbooks. It doesn't, and that's why I get you to read the original readings. So you can actually see that sometimes these guys actually admit what's going on. The textbooks don't transmit this stuff through. That's why I regard textbooks as a major reason why economics is such a mess right now. So ignoring those, Sharp also ignored his own qualms, by the way. That was a little, blink of being realistic, but he was an avid defender of the capital asset pricing model all the way through, certainly up to the last paper I read by him sometime in the early 2000s. So all this stuff took over the finance theory. The old stuff, which is more accounting based, disappeared. And the essential ideas were prices accurately reflect future earnings, and shares with a higher return will give you a higher correlation to will be more correlated to the trade cycle. And that seemed to work early on. But were those results a fluke? I'll talk about that in the next half of the lecture when I answer the phone that has just rung, which is mine, because I should have turned the damn thing off. See you in about 10 minutes.